Okay, we're going to go ahead and get started. Next. Welcome everybody to today's SCORE webinar in partnership with Spectrum Business, Why You Shouldn't Go It Alone, Legal, Accounting, and Insurance for Your Business with Evan Sarzan, Andy Presti, and Sean O'Rourke. Next. For today's webinar, you are in listen-only mode, meaning that your audio is on mute. We recommend that you maximize your Zoom window for an optimal experience. There will be opportunities for Q&A throughout the session, so please submit your questions at any time via the Q&A feature at the bottom of your Zoom window. We will be sending out materials following the webinar, and they will include today's slides as well as the webinar recording, and those will go out tomorrow. Next. With that, I'll turn things over to Tim Cantato to introduce himself. Tim?
Thank you, Kendra. Good afternoon, everybody, and welcome to the second webinar for the Spectrum Business Insights series, Ideas to Power Today's Business Owners. This webinar is entitled, Why You Shouldn't Go It Alone, Legal, Accounting, and Insurance for Your Business. My name is Tim Cantato, and while I'm not the presenter of this webinar, I have been a certified SCORE mentor for the last 5.5 years. I'd like to take this opportunity briefly to tell you a little bit about the SCORE Association. Sometimes known as the Advisors to America's Small Business, SCORE is a nonprofit association comprised of over 10,000 volunteer business counselors in over 325 chapters throughout the United States and its territories. In existence for over 55 years, SCORE members are trained to serve as counselors and mentors to aspiring entrepreneurs and business owners. SCORE chapters offer mentoring services, workshops, and webinars similar to the one that you're about to see, advisory board services for more established businesses, business owner roundtables, which serve as peer networking groups for entrepreneurs, and information resources like templates and instruction booklets through their website. SCORE mentors are experienced business executives with specialties and expertise in a variety of disciplines like marketing, finance, accounting, and many other fields. They are available to help businesses in all stages of a business's development, whether it be pre-startup, startup, or even ongoing concerns. And as such, SCORE mentors are trained and encouraged to develop ongoing relationships with their clients, meaning more than one-time meetings, but hopefully series of follow-up sessions to help promote client success. So you may be asking yourself, so how do I avail myself of the free help offered by SCORE? Well, you can request a SCORE mentor by going to www.score.org and click Find a Mentor. Go ahead and enter your zip code, fill out the mentor request form, and a mentor will reach out to you to schedule a session. Really, it's easy as 1, 2, 3. Now, the New York City chapter of SCORE is pleased to partner with Spectrum Business to bring you this series of training webinars. I hope that you will register, sign up, and attend each of the webinars that speak to your individual needs. I myself will be presenting 2 of them on May 24th and June 28th, and I hope to see you there then. We would like to thank Spectrum Business for underwriting this series of webinars. And in that vein, I would like to welcome Jennifer Ingram, the Vice President of Marketing, Small and Medium Business, to say a few words.
Hi, everyone. My name is Jennifer Ingram. I'm the Vice President of Marketing for Spectrum Business. And as you may know, we operate internet, voice, TV, and mobile solutions. We provide those to small businesses across 41 states. We're really pleased to be sponsoring today's small business workshop, and we're really pleased to be partnering with SCORE. Spectrum Business and SCORE, at the end of the day, we share the same goal. We want to help small businesses thrive. We understand small businesses are the backbone of the country's economy, and that small businesses play a critical role in our communities. I think we've seen that over the past year in particular. Small businesses in many ways are the glue that holds communities together. That's why we're sponsoring this workshop series that's brought to you by SCORE. It's really important for us to help small businesses get the support they need to start and grow their business. It's part of our commitment to the communities in which we operate. So thank you for attending today's session. On behalf of the entire team at Spectrum Business, we hope that you find this session helpful, and we hope that you sign up for additional workshops within the series. Thank you.
Thank you, everyone. We are now going to commence the webinar. We hope you enjoy it. Our first speaker is Evan Sarzan, talking about legal for small business. And with that, I'll turn things over to Evan to introduce himself. Evan? Evan, you may be on mute.
Thank you, Kendra. Can you hear me now?
Yes, we can hear you.
Thank you. My name is Evan Sarzan. I'm an attorney. I've been in practice for 40-some years, and I've done a lot of work with small businesses and startup businesses. And I wanted to speak to you today about some of the first issues you're going to encounter after you've formulated the idea of your business, when you ask yourself, well, what legal shape should my business take, and what do I need for the foundation to make that happen?
So first, we're going to do a quick poll, and the question is, what type of business structure do you currently have? And go ahead and make the selection. Is it a corporation, an LLC, partnership, sole proprietorship, or just starting out and looking to decide? And this will give a sense of who's with us in the audience today. So go ahead and submit your response. Give it a few more seconds as we've still got responses coming in. Okay, I'm going to go ahead and close that poll and share those results. Any comments, Evan?
Well, 50% of the respondents have LLCs. And considering that 26% are starting out and haven't made a choice yet, it's clear that the LLC is the most popular format that's been taken by people who have started their businesses. And we can talk a little bit about why that is as we go through it. What I first have tried to do is set out the different factors you want to consider when you're setting up your business. Obviously, you don't want to put a lot of money into the initial format of the business you use, whether that's an LLC or a corporation or something else. So you're going to be cost conscious. Once you do that, you want to make sure that the entity you choose is easy for you to handle, easy to operate. In some instances, if you're going to be bringing aboard investors, you want a structure that will allow you to do that, so that you have something that's open-ended and can be shaped to the particular needs of the business you're creating and the nature of the investors you're bringing in. Administration and record keeping are a part of Operation Ease, but there's a certain formality most organizations need for tax purposes and for their own internal record keeping purposes. The big topic, which you're going to hear about later on from Sean, is about liability, limited liability, insurance, and what you can do about it. I don't want to spend too much time on it because I think you're going to hear this more thoroughly later. But one of the central concepts of using an entity like an LLC, which means limited liability company, or a corporation, is that for business purposes, the company, the corporation, bears whatever liability there is. Now, there are certain exceptions to that rule, but the idea is that you're starting out from a point of view where your individual assets, your individual property won't be at stake if the business fails or the business gets sued and is found liable for something that is part of its regular business practices. So with that, let me go through the different entities and give you some ideas as to what they offer, pro and con. The most familiar, I think, for most people are corporations. And corporations are companies that are formed under the laws of your state, where you're going to be conducting business or where you choose to form your company. One of the attractive things is that it's very inexpensive to start. You file a certificate with the state, you get authorized, you get certain stock authorization up to a certain number that you choose, and you're off and running. Get your tax ID number from the federal government, and you're good to go. It gives you limited liability, and it's good for a small number of principals. If it's you, two other people, a small group, it works very well for that. And it will be handled, can be handled under certain tax rules as if you're in it as individuals, that all the profits and all the losses will flow right through. The con, on the other hand, is that if handled correctly and in accordance with the laws of your state, each state has a body of laws, there are certain organizational and operational formalities that you must follow. And if you don't follow them particularly, you can be subject to some sort of challenge or disqualification under the rules that you've chosen to operate. Now, limited liability companies are very popular now, as the poll indicates. They are also relatively inexpensive to start, but they are more expensive than the corporation to formulate. And you do have to go through the state process again. You need to have an operating agreement that's going to be mandatory. And you have to take the extra step in many places to actually publish a notice in a local newspaper. It can be an inexpensive one, but a local newspaper saying, we have formed this LLC, we're going to be doing business under that name. So that's one of the minuses, but the positive is that among the group of partners or members you choose to put into your limited liability company, you can be very flexible on the terms. There's no limitation on the number of membership interests, and you do not have to treat all members exactly the same based upon their membership interests. You can vary compensation, you can vary the share of profits and losses, and that way you can create a design that will fit the type of people you're bringing in and what their roles are going to be. This is particularly good when you're bringing in investors who will not have any active role, but will still want a share of the profits. Next slide, please. When you start out in business, very often, if it's just yourself and you're doing something that you consider to be relatively straightforward, you might think that it's fine to operate as a sole proprietorship, and in some cases it is. If you're going to operate under a particular name that's not your own name, you are required to file a doing business certificate. That's usually done in the county where you're going to be operating, and it's a relatively small amount of money to do that. So the startup costs are not significant. As far as running your business as a sole proprietor, it's like keeping your own set of records. You will enter your expenses, you'll enter your income, and you will work with an accountant to make sure that you're doing it properly and that you're separating your personal expenses from your professional expenses. The downside with sole proprietorships is that there is no limitation on liability, at least not from the point of view of the entity. itself, because it is you. So if you have assets in your own name, personal assets, if you run into a business problem and you get sued, those assets could be vulnerable. That's one reason not to do it. However, you are going to hear about insurance, and in certain respects, insurance can protect you with regard to certain kinds of risks, but it won't necessarily protect you, for example, on a lease where rent is due. If you don't pay the rent, the landlord can come after you personally because it is you personally who has signed. Partnerships are similar. They are not limited liability, and they have some of the accounting requirements you're going to find with LLCs and with corporations. So you do have those two negatives. While they're relatively easy to wind up, there are certain rules, and these again can be rules of the state in which you've formed your partnership. And you, of course, can enter into an agreement and set your own rules with your partner. But those are the negatives. The positive is it's not very expensive to get started. Administration is all internal, like a sole proprietorship, and you don't have any formality in operating the partnership. You don't have fixed stated meetings where you have boards of directors or you have shareholders you must meet. It's just you and your partners sitting down and talking through your business issues. I've separated agreements from the type of entity, but in all but the sole proprietorship, you're going to have to look at certain agreements because there are issues that are not obvious, and it's a great thing for both parties to have spoken to all of those issues. I should say more than both, all parties spoken to all those issues and have made some decisions about how they're going to allocate the responsibilities for the business. So the agreement, whether it's a corporation, limited liability, or a partnership, normally will set out duties. Who is going to be managing the administration, who's going to be in charge of sales and tech and other fields that are part of your business. It may be obvious if you're bringing in specific partners whose areas are those, but it may not be clear. And it may be something you must make some sort of determination and share that information so that everybody knows what they're supposed to be doing. Control is a large issue. Normally in entities, a majority, what we call a simple majority of 51% will control the decision making. There are areas under the law where you need more than 51%. And there are areas, for example, buying and selling the business where you want more than a simple majority. You want perhaps 2/3 or 3/4, and in some cases, unanimous consent. But the control is an issue, and the control is a function of ownership. I stated a little earlier that profits and compensation are topics that can be controlled flexibly using different entities. For example, in the limited liability company, you have more flexibility with regard to the allocation of profits and losses and investment capitalization. So that is something very important to set forth in your agreement, because there are arguments about these things all the time. And what you start out thinking is clear may not be clear as the business develops. So having this as a blueprint is an important thing to do. There are times when partners decide not to continue together for good reasons or for bad reasons, but it happens. And an agreement tells the parties how they should proceed. who is going to buy who out, and how are you going to set the price, and how much time will it take to pay that debt off. There are certain guidelines and there are customs. Those are the terms that you would put in an agreement for a buyout. Now, I've listed buy-sell separately because there are lots of businesses that are set up with the idea that they want to build their businesses and create value and eventually sell, have an acquisition by a larger company, which essentially will buy out the entity as a whole, the business as a whole. And you want to have provisions that say that if the majority votes to sell or to acquire, that the non-voting parties will either have the right to come along or to sell their shares to the remaining shareholders. So that's buy sell, and it's something we talk about as a take along or a come along provision. There are lots of other types of agreements, but I want to focus on the agreements you have with the people who work for your company. The norm is that employees work on an at-will basis. They're hired, they can be fired for any reason except a discriminatory reason. They can quit for any reason. And if you have an agreement that's going to differ from that kind of employment, what we call at-will employment, you're going to want to have an agreement that says the period of time, the compensation, what the duties of the employee are going to be, and what the rules and regulations are. Lots of companies, once they get into a number of employees, create handbooks, manuals, procedural guides, so that everyone who works for the company knows the rules. And it's a very important thing to have that, so it lays out procedures for filing complaints, for example, if there is an alleged discrimination within your company. It's very important that you, as the principal of the company, knows about it, has been given sufficient information, and can act on it. Take whatever steps are necessary, and the rules and regulations will advise the employees what they have to do and what they can expect in terms of redress of their grievances. In some companies, non-competes are extremely important, others less so. But essentially, it is to protect your company against an employee who wants to walk out and take confidential information, clients that he or she would not otherwise have known of, and prevent them, therefore, from starting a business using the goodwill that you've created in your company. And one last part of that is trade secrets. Intellectual property, which consists of patents and trademarks and copyrights, also consists of trade secrets. And trade secrets are things that are not registered, like trademarks and patents and copyrights. I think one of the best known is Coca-Cola. Coca-Cola has a formula, and it has remained secret since the late 19th century when it was first created. And that remains a secret within the company. And obviously, anybody who could leave the company, take that secret away, could do great harm to your business. So you protect your company for those secrets. And those secrets could be how you do your business, what your method is, your methodology and marketing for customers. It's a wide range of topics that can be considered trade secret. You would want an agreement specifically to protect that and to regulate what an employee can or cannot do. The last set of agreements I'm going to address are more general. They're, first of all, real estate leases. And in this transitional time of the pandemic, there is a shift in the use of offices. So many people have worked remotely, and it may be the template for businesses in the future. We don't know yet, but I think a lot of people have recognized that remote work is not necessarily bad for business or bad for morale, and it may become a factor. Yet, businesses still need centralized operations. They need it for manufacture, they need it for fulfillment, assuming that you haven't been gobbled up by Amazon, and you need it for the synergy of doing business. So there is a need for offices, and office leases can be very complicated. In big markets, certainly very, very complicated. And you must really consult the brokers who help you find the spaces and negotiate terms. And it is fundamentally a good idea to be working with a leasing attorney who knows what the customs and practices are, can look at a landlord's lease and see what problems lay ahead. Length of lease is important, of course, and the longer the lease, the more likelihood is you're going to be subjected to escalations in rent, but also in things like real estate taxes or maintenance of the property. To some extent, some landlords even try to hook you into certain capital expenditures. Businesses can't always predict their growth needs, and there will be times when you may find you've outgrown your space. So a lease that is good for a tenant is a lease that gives the tenant options, either to assign the lease to another potential tenant or sublease the space, or alternatively allows the tenant to terminate the lease. Now, leases don't necessarily have early termination dates, but they do have something else. They have lease guarantees where the principals of the business are asked to guarantee the lease. Now, the practice in real estate these days, most commonly, is that there's a limited guarantee given where a principal would say, if I let you know anywhere between 90 days and 180 days before we decide to leave the property, and we leave it in good shape, then the guarantee is over. That doesn't mean that the corporation that held the lease, the tenant corporation, is free from liability on the lease. But if that corporation doesn't have assets, the only thing the landlord can turn to is the principal's guarantee. So the lease guarantee is a very important feature. If you see a lease and you have an unlimited guarantee or one where there's no right to terminate early, that is something you need to get help with. The last area I'll cover is leasing for property other than office space. Businesses lease equipment of all kinds, from very large machinery to software licensing. It's not only a financial consideration and one that you should work with your CPA to figure out what's best for you, but it gives you certain flexibility because you don't have to buy a piece of equipment that you later will find that you cannot sell and that you've overinvested in and now are stuck with. So leasing presents you with an option. There are upfront costs, whether you own or you lease, that's a factor, but you can calibrate that with the length of time you use it, the ability to upgrade, and your changing needs. And I'll finally say that is true for software as well, as more and more software has gone from a purchase model to a leasing model.
Great. Thank you so much, Evan. So now we're going to open it up for Q&A. Our first question is it necessary for me to have a written partnership and or employee agreement?
It's not a requirement. It's not a legal requirement. You can do a partnership and an employment relationship at will. But as I said, you're leaving uncertain and undocumented precisely what the terms of the partnership or employment relationship will be.
Thanks. How would a sole proprietorship handle employee agreements in the case where the majority or all of the delegate workflow is typically assigned to independent contractors?
Well, independent contractors aren't employees, so you'd have a different form of agreement. You can still have, with an independent contractor, an agreement that provides for protecting confidential information, protecting trade secrets, putting in certain limitations as to what the independent contractor will do. What I'll just say is that a lot of people try to do independent contractors rather than employees to avoid the issues of payroll taxes and other employment type benefits. I'm not going to say you can't do it or you can't get away with it. What I will say is there is a test under the law, under the Internal Revenue Service, as well as state employment laws, as to whether or not it is actually an independent contractor or should be considered an employee. So just because you designated an independent contractor doesn't mean that it will be accepted legally as such if questions arise.
Thanks. Is there any reason to change a business entity once it's in operation?
There are many reasons why you might want to do it. You might start as a sole proprietorship and discover that you need to be a partnership. You may find that you need to have more than one partner, and you may find you need to bring in people on a relatively senior level. And by that, I mean as experienced as you might be. And for that, you may need the structure of a corporation or more likely an LLC. So it's easy, relatively easy, to go from one form of an organization to another, assuming you work with attorneys as well as accountants to make sure that you do it in a way that doesn't incur tax. And that can be addressed also by our CPA, but to make sure that you've covered all the factors that have to be considered when you do a transition from one form to another. But it is done. You can change the format, you can change the identity, you can change the name, you can change virtually everything. But you want to be careful how you do it, and you want to know a good reason for changing to the form you choose.
Thanks. There have been a number of questions about the business entities, and are the rules different from state to state?
The rules from state to state can be very different. If you are going to form a corporation in a given state or a limited liability company in a different state, you need to check those carefully. I practice in New York. I'm conversant with New York rules, but if I were to have a client ask me to form a corporation in another state, typically that might be Delaware, where there's a lot of corporate formation. I need to be conversant with the rules in Delaware. I need to know what's required for meetings and shareholders and what the law is in the event of disputes. So the requirements for formation are different, and the way they're interpreted also can be very different.
Thanks. You had referenced rigid rules in regards to forming a corporation. Can you just speak a little bit more to that?
Well, for example, a corporation asks you to set a number of shares. And you can pick 100, you can pick 1,000, you can pick 10,000. but that will be the number of shares you issue. So let's say you start with 500 shares and there are two people and you split them 250 each. Now you want to bring in a third person. Well, you either give back some of your stock or you have to issue more stock. If you have to issue more stock, you don't have any stock left to issue because the state had set the charter at 500 because that's what you requested. So those rules must be abided. Also, the nature of the stock can vary. You can have common stock. Common stock is what we call voting stock. You may have different classes of voting of stock. One, for example, that receives dividends only, has no right to vote. And these are all formulated at the state level. You would need to go to the state and ask permission for a new class of stock or an increase in your stock capitalization. There are also issues as to the initial value of the stock, but that's more technical and I don't think it's worth going into at this point.
Thanks. Is there a particular type of business license that would be best for an online only business?
Well, the word license, I'm not sure is the right word. We're talking about the format of the business. And for that, I don't think that any particular format is better than any other. You can work with the LLC format or a corporation or a sole proprietorship or partnership. What you have to recognize more importantly is that you're going to be in an online business and you're going to have to abide by the laws of the states in which you sell product or sell services. So initially, sales tax was unknown to the internet, but it's increasingly encroaching on internet activity. So you have to know that. With respect to licensing, licensing can be a different matter. If you're licensed, let's say, to practice medicine or to practice law or other kinds of professional services, those licenses still are regulated at the state level. And you don't want to find yourself practicing your profession in another state under state laws with which you are not familiar, because you can be held responsible for that. You even may face charges of doing business without a license. But I think that's something you have to take up individually. Most of the time, the services that are offered online by professionals are offered without fee and aren't meant to be binding as an engagement.
Thanks. Can a nonprofit be an LLC?
A nonprofit can be an LLC. It can be a corporation. In fact, I met with a new client last week who said, should I be a nonprofit or should I be an LLC? And the answer is you can be both of those things. But the issue really is whether you should be a nonprofit or not. How are you getting money? Are you being supported by donations? Are you receiving grants from foundations? If that is how you support your business operation, then you may very well be a nonprofit. On the other hand, if your income is derived from revenues from clients and or products that you sell, most likely you're going to be in the for-profit corporation market. The other thing with nonprofits is it has to be for what's considered to be a charitable purpose. Could be religious, could be educational, could be simply charitable. And so the purpose of your business has to meet the requirements, and these are state and federal requirements, that your purpose is an appropriate nonprofit purpose.
Thanks. What is the difference from using a subcontractor as opposed to an independent contractor? And are there tax implications in using either of them?
Well, I use the term subcontractor usually to refer to someone who is working under the supervision of a general contractor. So, simple example, if let's say you're having a renovation done on your house or your office, you can hire a plumber, you can hire an electrician, you can hire a contractor, and they can all report directly to you. If it's a big project, though, a complicated project, what you might want to do is hire a general contractor. A general contractor then subcontracts those portions of the work that he or she does not do themselves. So, for example, the general contractor will bring in a licensed plumber, will bring in a licensed electrician, will bring in an engineer to review certain conditions that have to qualify, for which it may not have the technical know-how as to how to put it together. And you should have some fairly good specifications from an architect or your own engineer, but the people who do that work are going to be responsible to the general contractor, and the general contractor is responsible to you. An independent contractor, completely different category. So, for example, a general contractor is an independent contractor. Subcontractors are independent contractors. But when we talk about independent contractors, what we are really talking about are people who render services to businesses that might otherwise be rendered by employees, but are not engaged as employees because they do the work according to their own means and methods, on their own time, and they may not be exclusive to your business. They can be independent and handle projects for a number of different businesses at the same time.
Thanks. Can you partner with another company or person without a change to your status, like your LLC status?
Well, with certain exceptions, a company or an LLC can be a stockholder in a corporation. You can form a business where you hold a percentage of stock and another company holds another percentage of stock. There are certain tax rules which prevent it in certain circumstances, but there's nothing fundamentally that would prevent that from happening. In lots of LLCs, you're going to find that the LLCs have members, and each of the members itself is an LLC. That happens fairly commonly, especially in real estate.
Thanks. For like a small retail business, is it better to hire part-time employees, full-time employees? Can you give us a little pros and cons for both?
Those are really business questions. And those are the questions that if a client asked me, I would then have to get into a discussion. I would either say to them, it's a business judgment, you have to make that judgment. Legally, you're going to foster more loyalty probably with a full-time employee than a part-time employee, but it may not suit your purposes otherwise.
Thanks.
So it's really a business question.
Thank you. Is it necessary for me to have a written, should I form my own corporation or limited liability company?
It's easy enough to do, and you can do it. The formation itself is not something that you need an attorney to do. But once you get past the stage of actually forming the company, questions are going to arise very quickly. So, for example, in corporations, there are two broad forms of corporations, what we call the C corporation, we call the S corporation, subchapter S corporation. And those designations signify how that corporation is going to be taxed. Will the corporation have to pay tax as a corporation? If so, that's going to be a C corporation. Most small businesses, though, don't start out as C corporations. They start out as subchapter S corporations. And that is not automatic. Once you've formed your corporation, you must file certain elections with the federal government and with the state government, advising those governments that you intend for the corporations to be taxed at the individual level. So at the end of the year, there'll be, the accountant will create a tax return for the corporation, will take the profit that's left, assuming you're profitable, divide it among the shareholders or the members on percentage basis, and give each of the members what's called a K-1 statement, which tells that shareholder and member how much income is being taxed by the taxing authorities, what they will have to pay as individuals. But the corporation itself will not be paying income tax.
Thanks. Is there a particular option that's more investor friendly?
My point of view, are you talking as between C and S corporations? Or are you talking generally?
Generally.
Generally, my experience is the LLC is the most investor-friendly format to use.
Okay, thanks. Well, that's going to wrap up our Q&A with Evan. We appreciate, Evan, your presentation and you're taking all those questions.
Very
With
well.
that, we're going to go ahead and move on to accounting for small business with Andy Presti with Presti and Nagley. So with that, Andy, please tell us a little bit about yourself. Andy, you may be on mute.
Hi, my name is Andy Presti, and I am a partner in a local accounting firm here in New York City. We're going to talk about a lot of the things. It's going to sort of piggyback on what Evan said in his presentation. So let me share my screen and we will get started. Okay, so there's a polling question. I believe, Kendra, you're going to put up the poll question?
Absolutely. So do you currently have or are planning to obtain a PPP loan, new or current, an EIDL loan, the Restaurant Revitalization Fund, other loan or funding, or none of the above? And so we'll give it a little bit for people to submit their responses. And this is just to give us a sense of who is with us today and what is the context. Got lots of responses coming in, so I'm going to give it just a little bit longer. Okay, and I'm going to go ahead and close out that poll and share the results.
Okay, so of the loans, the PPP loan, 19% of the people had. And the reason I put this in here, I mean, outside of COVID, this wouldn't be the leading topic of talking about accounting and business, but it seems very relevant today. So I'll touch on the PPP loans and what's gone on with them, as well as the EIDL loans. But let's get started. So as Evan had mentioned, there are multiple choices when you're going to start a business. There is no quote unquote best choice. There's a more common choice, which has been the LLC. But I just want to talk about from a tax perspective, what each one of these means. Sole proprietorship. So if you start doing work for someone, you could do consulting work, you can do Google search engine optimization for a company, and they pay you direct as an independent contractor, you are automatically a sole proprietorship. You don't need to register anything. You don't need to do anything. You could use your name as the business name. A sole proprietorship will report its income and deduct its expenses on your individual income tax return by filing a Schedule C. So a sole proprietorship is the easiest way to quote unquote start up in business, albeit not the most recommended way, especially from a liability perspective. Want to mention something as well. There is no one of these entity structures that a blanket statement can say that's the best way to operate for tax purposes. And I'll explain that in a bit, right? So sole proprietorship, very simple to start, no limited liability. So it's you are on the hook for anything your business does. It is the easy way to start if you're simply going to be doing consulting work that does not have a lot of liability attached to it, right? So very simple to start. The question we get all the time is, I'm a sole proprietor. If I form an LLC, am I going to save money? You're not. A single member limited liability company. So if you go out and form an LLC and you are the only member, that's called a single member limited liability company. It's actually disregarded for tax purposes. A single member limited liability company does not file its own tax return. It is treated for tax purposes as if it does not exist, and you file as a sole proprietorship. You will file the identical tax return if you formed a limited liability company, which you are the only member, that you would if you never formed that limited liability company. Now, it does afford you the limited liability protection that Evan mentioned. So from a legal perspective, it's recommended many times, but from a tax perspective, it will be treated as a sole proprietorship, okay? So when you file as a single member limited liability company and or a sole proprietorship, on your personal tax return, you'll be paying both income taxes on the net profit of your business, that's the sales minus the expenses, in addition to Social Security and Medicare tax. So both of those taxes are computed on your personal income tax return when you operate as a sole proprietor and or a single member limited liability company. You cannot be on the payroll of your own single member limited liability company or sole proprietorship. Right, so you can't issue yourself a W-2. You cannot be considered an employee of that company. You can hire other employees, but you cannot be considered an employee. So you essentially end up paying tax on the net profit of the business on your personal tax return. 99% of businesses, small business that start, have the goal of basically paying individual income taxes as opposed to business level taxes, right? So even though you have a limited liability company, there are no company level taxes. All of the taxes are on your personal return paid by you as an individual. A partnership is basically two sole proprietors doing business, two or more sole proprietors doing business together, right? As Evan mentioned, there is no limited liability protection if you operate as a general partnership. Very simple to form, not really used much today. If you're going to consider operating as a partnership, we would recommend you form a limited liability company with multiple members. That would be initially taxed as a partnership. Corporation, S or C, if you go out and form a corporation from a tax perspective, you're automatically a C corporation. A C corporation is Apple, Ford, General Motors. You really don't want to operate as a C corporation. There are limited instances when we would recommend a C corporation to a small business. One of them being, do you have foreign owners? Many times foreign owners of US businesses want to operate in the C Corp structure. 99% of small businesses that form a corporation will make an S election, a subchapter S election. Subchapter S election essentially says, whatever the profit of the business is, we're not going to pay corporate level taxes. It's going to flow through using a K-1 down to the individual owner of that corporation, so they will pick it up on their personal tax return and pay personal taxes on it, okay? So the takeaway here is generally, if you're going to form a corporation, you're going to want to do an S election. S elections need to be done within 75 days of the beginning of the tax year. Huge mistake people make. They'll form a corporation in March, then comes tax time, right? A year later, and they say, oh, I want to be an S Corp. Well, you had 75 days from the day you formed the corporation to make that S election for that year. So just keep that in mind. Limited liability company, it's the same as a single member limited liability company, except if a limited liability company has more than one member, it's a multi-member limited liability company. The default taxation of that is as a partnership. So if you form a limited liability company with more than one member and you make no elections, you do nothing, it will default to be taxed as a partnership. Again, a partnership is a flow-through entity. There are no business level taxes for a partnership. All of the taxes are passed down to the individual members. Now, I went through all of these, so someone would say, well, I'm starting a small business, which should I choose? It really depends on multiple factors. How many people are going to be in the business? Where is the business located? So what you read online typically is the federal statute for how all of these different entities are taxed. Each locality has their nuances with these. As an example, New York City does not recognize S corporation. So if you form an S corporation in New York City, there is a corporate level taxation on the profits, in addition to you paying personal taxes on the profits. So each state, each locality has their nuances with these. The takeaway is, do not go out and form the entity without first sitting and saying, this is what I'm contemplating. This is the business I'm going into. This is how many owners there are going to be. This is where I'm forming the business. And this is the plan for the business 2 to 3 years out. Based on all of those factors, then between someone like Evan and myself, we could recommend that based on what you've said, we recommend the following entity to be the most cost effective from a formation perspective and from a tax perspective, okay? And it does vary from locality to locality, from type of business to type of business. There were a couple of questions regarding, which is the best type of entity from a funding perspective. Well, if you're looking to bring in outside capital, a lot of them want to have a C Corp structure or an LLC structure, typically not an S Corp structure, right? Just to throw another twist in to show you the complexity of the tax code, you can form an LLC and choose to tax that LLC as a corporation, just to confuse things a little further. With all that said, what's the predominant entity that we would recommend to people? Most likely the LLC, because it gives you the most flexibility. If you're a single member, you could operate as an LLC. You have more than one person, you could operate as an LLC. If you want to tax yourself as a corporation for whatever reason, you can do that forming an LLC and then making an election to tax the LLC as a corporation. So the LLC really does give you the most flexibility to basically do what you want on a go-forward basis. We've had clients who formed LLCs, and a couple of years later, they wanted to then convert the LLC to a C Corp, right? Because they're bringing in investors and they wanted the C Corp structure. You can do that. All right. So LLC is probably the most common entity that people would form today. The questions we get, well, from a tax, what's the best for tax purposes? There is no easy answer to that. Every circumstance is unique, depending on multiple factors. So you really have to look at your structure and decide what's going to be the best for you. So I'm going to jump to this slide first, even though I just skipped over a slide. So what happens is we get the question, what is the best entity? Like, what can I deduct if I'm a corporation? What can I deduct if I'm an LLC? What can I deduct if I'm a sole proprietor? The quick answer is the entity structure does not control your deductions. What controls your deductions on a tax return are basically testing every deduction, putting it through the 3 tests. Is what I spend money on ordinary, necessary, and reasonable? What do I mean by that? Is it in the ordinary course of the business that I have an expenditure, right? So I run an accounting firm, I rent office space. It's in the ordinary course of business. Is it necessary? Well, is it necessary to me to have office space to run my business? If the answer is yes, then the expenditure is deductible. Is it reasonable? Well, I rent space in Manhattan. It's reasonable. I'm paying market rents. So therefore, the rent of my office space in the city was both ordinary, necessary, and reasonable. What doesn't pass this test, right? And you get the quasi personal expenses that are always on the fringe of this. So I need a pen, right? You need a pen to do business, have to write things. It's ordinary and necessary, but I can't buy $1,000 gold pen because it's not reasonable. So every time you have a question, is this deductible? If it passes these 3 tests, it's deductible. Let's go to some of the expenses that always cause problems. I take someone to dinner, right? Is it in the ordinary course of my business? Well, if you have to entertain and take clients to dinner, or a prospective employee, you maybe want to meet them over dinner and see how they are, well then yes, it's in the ordinary course of business. Is it necessary? Well, you could deem it to be necessary. The client wanted, I took the client to dinner, I was able to get more business that way, so it's necessary. Then you get to the reasonableness. Is it reasonable? This is where there could be an issue depending, you can't, buying $1,000 bottle of wine may not be reasonable, depending, to try to get a client that's going to give you $500 of revenue. So IRS would look at all 3 of these in every type of expenditure, right? Taking your spouse to dinner to talk about business, they're not going to allow that. It's not necessary to go to dinner to talk to your spouse about your business, right? So that's how they would throw out an expense. So any expense you can come up with and question, is this deductible? You have to apply these 3 tests. Now we can get into, what's deductible, what's not deductible, all different types of questions, but time constraints just aren't going to allow us to do that. One thing in general, for you to have a deduction, you have to spend money. There are no out of the air deductions just because you're in business. So summarizing everything you spend money on, all your deductions are going to come from that pool. There are no other types of deductions, except, that's why I skipped the slide before, this. There was a new deduction that came about in the 2018 tax code change. It's called a qualified business income deduction. I'm going to focus on this because this deduction potentially could affect what type of entity you want to form. The reason I say is this: what is this deduction? No matter what type of entity you operate under, sole proprietorship, partnership, LLC partnership, S corporation, those are all considered flow-through entities, meaning there's limited business level taxation, and you're really picking up all the income on your personal tax return. That's what they mean by flow-through. So for flow-through entities, this deduction is in addition to your general business deductions, your rent, your employees, your travel. This deduction is in addition to that. It's basically 20% of the profit that's left. So let's go through a quick example. You have $100,000 of sales. You have $40,000 of expenses. You have a $60,000 profit. Your QBI deduction would be an additional $12,000. So rather than paying tax on $60,000, you would pay tax on $48,000. That's the QBI deduction, qualified business income deduction. It came about to bring parity between flow-through companies and C corporations. The tax cut of 2018 dropped the corporate tax rate from 35% to 21%. Well, that's for C corporations. What about all the flow-through entities? They didn't get a similar tax break because they don't pay corporate level taxes. That's why the QBI deduction came about. It's to bring parity between the smaller businesses, the flow-through businesses, compared to the larger C Corp businesses, right? Now, there's some rules to this. Government's never that simple. Can't just be 20% of the business profit. They have to throw nuances in. First nuance, if your taxable income on your individual income tax return exceeds these limits, 315,000 joint, 157,000 single, a second test comes in. It's not simply 20% of the business profit. Let me go through an example of that. Let's assume you have a $500,000 business profit. That's going to flow through to your personal tax return. So that clearly would push your personal taxable income above these limits. In that case, the QBI deduction is the lesser of 20% of your business profit or 50% of the W-2 wages that your company paid to its employees. So let's assume you have a company, you deal with all independent contractors, 1099 people. You really don't have employees. Your QBI deduction is going to be 20% of your profit. So your profit was 500,000. So that's 100,000. Or 50% of the W-2 wages paid, which is zero. So the QBI deduction is zero because it's the lesser of those two. In that instance, you would want to operate as an S Corp. Remember before I said you can't be on the payroll of your own sole proprietorship or limited liability company. You can be on the payroll of your own S Corp. So the structure would be take that same business, make it an S Corp, put yourself on the payroll, pay yourself a W-2. Let's assume you did that for $150,000. So let's go back to the same example, 500,000 profit, but you pay yourself $150,000 W-2. You still have 500,000 to pick up on your personal return, 150 W-2. Now the profit of the company is 350 because you're able to deduct that W-2 as an employee. But now the QBI deduction is 20% of the 350, which is 70,000, or 50% of the 150,000 W-2 that you paid yourself, which is 75,000. So now you've created a QBI deduction of $70,000. So rather than paying tax on 500, you're paying tax on 430. I know I went through that quick. Don't concern yourselves with understanding the mathematics behind it. The takeaway should be, I have to lay out my business. If your business is going to have profits that are going to push your taxable income above a certain level, that would control what type of entity you might form for that business, right? If your business is not going to be at those levels, that might control what type of business entity you would form. So the business entity formation has to take into account what business are you in, what are the membership, what are the owners made up of? If there are foreign owners, you have limitations on what type of entity you can form. Are the profits going to be in excess of certain dollars? That would push you towards certain types of entities. What state and city are you doing business in? That would potentially push you to a different type of entity. So the real takeaway is, do not run out and form an entity without first considering all these different aspects of how that business is going to operate. What are the profit levels going to be? Who are the owners going to be? Where are we going to be operating? In what locality are we going to be operating in? And what's the future of the business? Or am I going to bring in equity investors down the road? So on and so forth. With all that being said, still the LLC is probably the most common because that can be converted to an S Corp if the profits start to increase and you see that this QBI is going to start to be limited. You could then convert that to an S Corp, put yourself on the payroll. If you see that it's not, you could remain an LLC, which if you are the only member, you're taxed as a sole proprietor, right? So the real takeaway from a tax perspective of what type of entity to choose has multiple aspects to it that need to be considered before you go out and form the entity. I can't tell you how many times people run out, form the entity, and then come sit down and say, now what do I do? So really the takeaway is get the advice before you start the business. If you're already in business, have it reviewed to make sure that you're maximizing this QBI deduction. And again, if your income are below these levels, it's very simple. It's 20% of your profit, no other limitations. If your income are above these levels, that's when you have to consider, am I in the right business structure? Let's assume an S Corp is the way you want to go then. And am I on payroll for the proper amount? All of those are factors that would need to be taken into consideration. A couple of other general things that happen when people look to form a business, and I saw it in a couple of the chat room questions. Where you form the entity generally does not control the taxation. All the time, I went out, I formed a Delaware entity, a Florida entity, a Texas entity. These are no tax states or low tax states, but I'm doing business in New York. It will not matter that you form the entity in a zero tax state. It matters where the revenue is being generated and where you live. So let me go through a quick example of that. You form a Florida entity for a business you're operating in New York and you live in New Jersey. Florida has nothing to do with this company other than that's the state that you form the entity. You are going to have to register that entity in New York as a foreign entity because it wasn't formed in New York. Foreign doesn't mean another country in this instance. Foreign means it's not the state in which the entity was originally formed. So you're going to have to register that entity in New York if you want to operate under that entity in New York. And now you live in New Jersey. All of the profits from this business are going to be put on your New Jersey tax return. In addition, you're going to have to file a New York non-resident return to report the income to New York because the income was sourced to New York. You'll get a credit in New Jersey for the taxes you pay to New York, so you won't pay double taxation. But forming that entity in Florida did nothing for you from a tax perspective. You generally pay taxes to the state in which you live and the state in which your income is derived, not where the entity was formed. So we get that very, very often, that misunderstanding, okay? State taxation has become infinitely more complex than federal taxation. So choosing where to locate your company depends on where you live, depends on the future of where the company is going to do business. There are a lot of factors in that. So even choosing which state to form the entity in should be done with conversation and with planning. Everybody, you always hear Delaware, and Evan can talk to this better than I can, but Delaware generally is friendly to companies when you have shareholder derivative suits and things like that. Delaware is the state of choice to form your entity. And then you have to register in New York or New Jersey or wherever you're doing business, okay? But that's why Delaware is chosen so often. It has to do with corporate law more than taxation. In fact, it has everything to do with corporate law and very little to do with taxation. But again, that's more Evan's territory than mine. So that's in general. So when you're looking to form what type of entity to form, you have to take into account, again, where you're doing business, how many people are in your business, who the owners are. Again, foreign owners, you generally want to stick with the LLC or C Corp structure. You cannot have foreign owners as an S Corp. All right. And the one tax aspect, the real major tax aspect to take into account is the QBI deduction. Will the entity structure I set up maximize my QBI deduction? Now, QBI just started in 2018. It might very well go away if the current administration changes the tax code. But as it stands today, this would be one of the major considerations as to what type of entity to start out as. Okay, and even with that, start out as the LLC. If you need to tax that as a corporation for the QBI purpose, you could always make that election. So, again, LLC is probably the entity of choice when starting all of this. So that's basically, now, if we opened it up to questions, I'm sure I'll get all types of questions. Can I deduct this? Can I deduct that? And we don't have time in this type of situation to sort of go into that. But just remember, deductions have to pass these 3 tests. If you're thinking of pension planning, right? Pension plans are available to all of these entities. Most of them are all interchangeable, no matter what entity type you have. So let me talk now a little bit about what's very, very relevant under these COVID times. Small businesses, most small businesses were eligible for PPP loans, which started back in March of 2020. Schedule C, this was a big misunderstanding. Sole proprietors were also eligible for PPP loans. I can't tell you how many sole proprietors that I've talked to that didn't realize that they were eligible as well. You don't need an entity to apply for a PPP loan. PPP loan stands for Payroll Protection Loan Program, Payroll Protection Program. I don't want to get into the nuances too much of it, but it is open now. The deadline is May 31st, but 3 days ago, we started to get indications from the SBA that they've ran out of funding. So while it is open till May 31st, it is temporarily shut down. That's why it was on a first come, first served basis. If you did get a PPP loan, receiving the loan is not a taxable transaction. The loan was calculated at 2.5 times payroll cost. And again, a Schedule C don't have to have employees, even though it's a paycheck protection loan. If you had a Schedule C, an independent contractor, sole proprietor with no employees, you qualified for a PPP loan. The maximum PPP loan for a Schedule C with no employees was $20,833, which is basically $100,000 divided by 12 times 2.5. That's how the loans were calculated. There were 2 rounds of a PPP loan. The first round was back in March, April, May, June of 2020. The second round opened up in January of 21. Same rules as the first round, except to get a second round PPP, you had to show a 25% reduction in revenue. Okay, so that's just the broad overview of the PPP. The takeaway should be that if you have a business and you've never looked at a PPP loan, you should. Right? Talk to your accountant, go online, get information to see if it's not too late for your business to apply for a loan. Now the funding ran out, but typically this happened back in 2020 as well. Congress stepped up and said, we're going to fund it with another $100 billion, X dollars, whatever. So hopefully the funding opens back up. but the hard due date is May 31. They may change that as well. So again, the takeaway is if you've never done this and you are in business, you should look into whether you qualify or not. You had to be in business on February 15th, 2020 in order to qualify for this loan.
Andy, we have a ton of questions. And so
Okay.
what I wanted to ask you is, if people have questions, what is a good resource for them to get their questions answered, since we won't have enough time to answer them all today?
Well, I'd be more than willing to answer questions on any of this stuff relating to PPP or anything in general for small business. Kendra, I think they can Google us or whatever,
Yes.
we're here to help. So
Great.
just one other topic. So on the PPP loans, they are forgivable. So you get a loan, quote unquote, a loan, but then you apply to have it forgiven. We get this question all the time. When is the due date to file for the forgiveness applications? It's essentially 10 months from the end of the covered period, which is typically 24 weeks from when you got the loan. So essentially, the forgiveness application is due 16 months from the end of the loan funding date. All right, so if you got a loan on, what do I have an example here? On June 1st, 2020, the forgiveness application is September 16th, 2021. Still plenty of time for anybody who got even the first round PPP loans. Okay. EIDL loan, these loans are still open. They are being funded. There is no forgiveness on these loans. These are typical SBA EIDL disaster loans. Loan could be up to $500,000, it's 3 3/4% interest, 30-year amortization. These are applied directly through the SBA. PPP loans are applied through your bank or a bank or any bank. But the SBA economic injury disaster loans are applied directly to the SBA. Okay. Kendra, why don't we open it up for questions?
Okay. So if somebody is looking for advice on an entity, on the best choice for an entity, would a CPA be a good resource, or who should they be talking to?
Yes. It's interchangeable between the attorney and the accountant. Obviously, being an accountant, I would think the first stop would be, what would be the best entity for my business from a tax structure and from an operating structure, and then making sure from the legal side that there's not an overriding reason on the legal side that what you choose on the tax side would not be the best. Quick example, rental real estate, we get this all the time, absolutely almost 100% an LLC for rental real estate, no matter how large or how small.
Thanks. Can you speak quickly to home office deductions?
Okay, so home office deduction, very relevant over this past year. There are 2 tests you need to pass to qualify for the home office deduction. The first test is my home office my predominant place of business? Now, during COVID, that most of the time is very easily answered, right? But let's say non-COVID. I have an office in Manhattan. I have an office in my home. I cannot deduct my home office because my predominant place of business is my Manhattan office. So everybody may do work at home, that doesn't automatically qualify them for the home office. So once you get past that first hurdle, let's assume that your home office is the predominant place that you do business these days. You don't have a formal office anymore, and it might be very relevant on a go-forward basis as well. The second test is that part of your home office has to be used exclusively for business. Now, this is where a lot of people say exclusive. That's a tougher one to pass. My practical experience with the Internal Revenue Services, that second test is not the relevant test. It is a test, but it's something that they hardly even deal with when they're questioning a home office deduction. If you can show that you predominantly work out of your house, right, you qualify for home office. Now it's, well, what percentage of your home, or is that piece of the home you use as a home office exclusively used in business? Very, very difficult. You have your computer on your dining room table, that's not exclusively used for business. But put that second one aside, because again, IRS has been very lenient on that. Let's assume you passed the first test. How do you calculate the deduction? I have a 1,000 square foot apartment. I want to say I use 100 square feet for where I have my desk set up for a computer. 10% of my home is used in business. Let's assume I'm a renter. You would add up your rent, utilities, cleaning, homeowners insurance, or renters insurance, add that all together, multiply by 10%. So it's the cost of maintaining the home multiplied by the percentage of the home that you're using in business. That's how you claim the home office deduction.
Thanks, Andy. So we're going to have to go ahead to the next section, but I do want to let everybody know that if you have questions, Andy very kindly said he would take questions, respond to them. Andy is with Presti and Nagle. They're located in New York City, and you can Google them, and you will receive these slides with the spelling of Andy's name as well as Presti and Nagle. Also, I just wanted to say, several people asked, Andy said, gave so much information, how will you access it? When you view the webinar recording, there is a transcript of the everything that Andy said. So with that, let's go ahead and move on to Sean O'Rourke to talk to us about insurance.
Okay, I got my screen shared. Hopefully everybody can see it and
Yes,
hear
we
me.
can.
Good. So we are ready to go. Thanks very much, Kendra, Andy, and Evan. Thanks very much for priming the pump, because I was watching all the Q&As, and I'm afraid I'm going to be just as sort of open-ended as Evan and Andy were, because the favorite phrase in my former life and current life was, it depends. And a lot of what I'm going to tell you today is general information about insurance, and as it relates to you specifically, will depend on what you do, where you do it, how you do it, so on and so forth. So for the most part, what you're going to hear out of me now is going to be general information, and then I'll try to be a little bit more specific if I can during the Q&A time at the end. So again, my name is Sean O'Rourke. I'm a cyber liability consultant for Combs & Company, which is an insurance brokerage firm and consultancy. We're headquartered in New York City, but we operate nationwide. And prior to joining the firm, I spent 20 years in technology. I ran my own company for 12 years. I also had 2 other startups that barely made it out of the gate. So I'm quite familiar with a lot of the questions that were being asked before when it comes to starting a business, insuring it, and what have you. Again, my information will be available. You're free to reach out where you can. And so, Kendra, if you want to do the poll question, I'll wait until folks answer that to get started.
Absolutely. So go ahead and let us know, what does your business currently have? Commercial insurance, workers' comp, health insurance, cyber insurance, or none of the above, just starting? So we'll give it just a few more seconds for people, and you can select multiple choice. You can select as many as apply to you.
And just let people know, commercial insurance is sort of an umbrella term for stuff like general liability, professional liability, errors and omissions, and the such.
Okay, I'm going to go ahead and close that poll and share the results.
Okay, so the majority of the folks who are just starting out don't have coverage, but a decent amount do. And some people even have cyber insurance. Yay you, because that is my my area of expertise, and we will talk about that toward the end. So the topic of this conversation is going to be what insurances are really required, you should have, technically, unless you have some sort of contract or legal requirement, Insurance is a prerogative, not necessarily one that you want to take lightly because you are exposing yourself to possibly paying for everything out of pocket. When I'm done, what I'm hoping you get is an understanding of the protections that commercial coverages offer, the differences in various commercial insurance coverages, workers' comp and state mandated disability, health insurance, and cyber insurance. And the reason why I have cyber insurance broken out is because a lot of people sort of misunderstand its purpose and how it works with the other insurances that a lot of people do know because of its the prevalence of those coverages for most businesses. So why insurance? The best way to put it is to protect your company and your personal assets. When you start a business, regardless of the way that you started up, whether you're a sole proprietor, LLC, S Corp, C Corp, or what have you, there is a risk that you are taking should something go wrong and somebody hold you liable, that you are going to be responsible for compensating that person for the assumed liability. And when you do that, that costs money. And there are legal ramifications, possibly civil ramifications if you fall under some sort of regulatory coverage. And what you want out of the insurance is the ability to pay that without paying out of pocket. The other part of insurance, what it also does is it gives you access to expertise in some instances, whether it be legal, cyber-wise to some cyber folks or elsewhere, to help guide you through an issue that you might be having. And I'll try to get into some of that, but again, we could go down so many rabbit holes that we just don't have the time for it here today. So in this regard, commercial insurance, as I said, is an umbrella topic that covers most professional insurances and professional coverages. There is a long list of them. I have a slide with Combs and Company's area of expertise, and under commercial insurance, I had to break it up into 3 different columns because there's so many different types of coverages out there. Basically, the word insurance is pretty ubiquitous, but when you get down to it, based on what you do and how you do it, may determine the type of commercial coverage that you need. Workers' compensation and state mandated disability, these are coverages for your employees should they be injured or, heaven forbid, killed while in your employment and while performing their duties. These are, and we'll go into them, these are mandated in workers' comp is mandated in all but 1 state. State mandated disability is in fewer states, much fewer states. But if you do not have these coverages in the states where they are required, the penalties are severe. They are usually not waived, and they could possibly bankrupt you. So this is one area that you want to focus on if you plan on having W-2 employees, and that's what I specified, W-2. The 1099s we'll try to touch on, but they create actually more of a headache for you than a W-2 does. Health insurance. Pretty much everybody knows this is insurance that you purchase to help you defray the costs of doctor's visits, medical procedures, medicines, and the such. Health insurance can be done as an individual, and it can also be purchased through companies if companies have it as a group benefit. And we'll talk about that as it relates to companies, not individuals. And then cyber insurance. Cyber insurance is insurance to cover your technology and the digital data that you hold or access for your clients or customers. And we'll get into a little bit more of this, but it is segmented out from most other commercial insurances now by most insurance carriers because of the increasing threat of something actually happening to that technology or that digital data. And all you have to do is open up your browser or your newspaper, and inevitably there is going to be some sort of cyber event. In fact, over this weekend, one of the Northeast main pipelines for oil was hit by a ransomware attack, and it had to shut down. So I expect to be paying more for gas when I go to the gas pump in a day or two. So in commercial insurances, we're just going to go quickly over these. Again, we could go through them in more detail at a later date. But essentially, these are what are the primary insurances that you would see as a startup business. And for the most part, these are what it's going to protect your company for the services and or products that you offer. So general liability, think of this as physical assets. General liability is typically a requirement if you lease an office space. As Andy was mentioning, he has office space in New York City. In fact, I'm in our conference room here in New York City. And as part of the lease, we had to have general liability. That's because general liability will protect, not protect, but it will offer protection should anything happen within the four walls of our office space. Should anything be stolen, if somebody who's visiting us slips and falls and hurts themselves, if they slip and fall outside the building, but technically on the building's premises coming to see me, well, then our general liability would have to be there to potentially compensate those folks since they were coming to see us. Again, there's all sorts of depends and caveats with that scenario, but I just wanted to give you an idea. General liability could also offer you product liability. Again, if you sell a product, if you sell cosmetics, if you sell a widget, if you sell a water bottle like I have sitting over here, you should have product liability on there. Sometimes product liability will fall under the general liability policy. Professional liability, errors and omissions, and malpractice. Those are essentially all the same types of coverages, and they all typically refer to a service-based business. I work for an insurance brokerage firm. I do not actually provide the insurance policies. An insurance carrier does that. But what I do is I make recommendations. I use the information that is provided to me by a prospect to make recommendations as to what kind of coverages they should get. Well, if something happens and I miss a coverage, or I underassume what the amount of their sales would be and I leave them exposed because I didn't suggest enough coverage, they could turn around and hold me liable on that. And without one of these coverages, I may have to pay, if I am found liable for it, I may have to pay out of pocket. That's because I gave advice. And when you think of these kinds of coverages, these are usually about advice. These are about your expert opinion that you are giving. This is not something that you would have if you were selling a water bottle, because the water bottle is not advice. The water bottle is actual physical product. Typically, your advice does financial damage, not physical damage. That is not always the case, obviously, because doctors have malpractice insurance and their expertise can actually cause physical damage to a person, bodily damage to a person, or death. So for the most part, though, if you're a service-based business, you're going to look to these coverages. Directors and officers, if a company has board members, has executives, which most companies do, directors and officers is very specialized insurance. And I don't want to go too much into it because as a startup business, it carries less weight than as you grow as a business and increase your exposure. But essentially, it will cover the directors and any named officers within your company. Employment practices liability, EPLI is how this is referred to, is a growing area that helps cover a business for issues arising from their interactions or relationships with their employees. A lot of times what we see is this is utilized to help cover businesses for potential sexual harassment lawsuits or claims, claims that you fired somebody because of their race, because of their hair, because of their religion, or what have you. Basically, you did something against the protected class and they are bringing a case against you. Employment practices liability insurance will cover you on there. Automotive, this is just commercial version of what you would have as a personal. Crime, this is more along the lines of if an employee steals items from you, and I'm not just talking staplers and what have you, but they embezzle money and whatnot. If somebody comes in and actually steals equipment out of your space and whatnot, and it's different and a little bit more specialized than the coverage general liability would give you, but the crime policy does come into play, not so much for startups, but a lot of times if you are growing, you have a lot of inventory or equipment on site, you would look to get in a crime policy. Business interruption, this comes from a physical disruption of your business because of some sort of event, whether it be a fire, or hurricane, flood. Again, we'd have to look at it because it all depends on the flooding and how it was caused. But essentially, if there's a physical disruption that prevents you from conducting your business, this policy would take effect. And then an umbrella, a lot of people refer to it. In fact, I had a question on it in the Q&A during Evan's presentation. An umbrella is basically just a backup or an additional layer of coverage for an existing coverage that you have. So if you have a general liability coverage that is $1 million in coverage, but let's say the landlord is saying they want you to have a $3 million umbrella, basically giving you $4 million of combined coverage, well, then the umbrella would take effect after you've used up that first $1 million in general liability coverage. Umbrellas are not usually relevant for startups. Again, the numbers don't justify it, but sometimes if you are leasing space, if you are getting into other contractual obligations, sometimes that is a requirement on contracts. So workers' comp and disability, this is one that I wanted to focus on because this is the one that usually gets by people as they are hiring employees, because all they think to do is, well, I have to pay taxes for them. That is not the case. Workers' comp and disability is a requirement in a number of states. In fact, if you look at it for workers' comp, it is a requirement in 49 of the 50 states. Texas is the only one where it's optional. Doesn't mean that an employee cannot bring an action against an employer in Texas. It just means the employer doesn't necessarily have to have the insurance to cover that. And essentially, the premiums are paid by the employer because you're covering the potentiality of something happening to your employees. And this is for monetary and medical benefits should an employee be injured while on the job, while performing their assigned duties on the job. This workers' compensation will not come into effect if they are injured playing in the company softball game, or if they're injured at home and they're slipped down the stairs as they got ready for work. This will not come into play. There are private, which means you come to somebody like us or another broker or agent, you can get workers' compensation insurance from particular commercial carriers. There are also states, most states also have an option where you can go through what's called a state fund. New York has a very robust state fund where a lot of companies, especially small companies, go through there. It's not necessarily better or worse, it's just different. And there are a few more restrictions on what you can do when you go through a state fund. Here's the key. Penalties are significant. In New York State, for every 10 days that you do not have workers' compensation insurance on an employee, the fine is $3,000. That is for every 10 days. And like I said, fines are often not forgiven. They may be negotiated down, but they are not forgiven, and you're going to have to pay them. So if you have W-2 employees, if you're doing the payroll yourself, understand that you must have workers' compensation insurance, either from the state or from a private entity. If you are going through a payroll company, typically you can buy workers' compensation insurance through that payroll company. I won't tell you you'll get the best deal from them. You may actually pay a higher premium than you would elsewise, but it's a much simpler process if you go through the payroll company because they can just deduct the workers' comp insurance from the payrolls each and every pay period. And they will make sure, and it's on them, it's their responsibility to send it to the state and prove that you have the insurance. Disability, we won't go too far into it because you can see there are 5 states and Puerto Rico where this is mandated, state mandated disability. It's also, penalties can be severe. The premiums are paid by the employer, just like workers' compensation insurance. There are private and state. This is used if the employee is injured on or off the job. So it's different from workers' comp in that it will cover off the job injuries. And a lot of times where it's not required, you might have it on key employees that you really can't afford to lose. And if you do lose, there is a potential to where you might suffer lost revenue, in which case then you can use this disability insurance to help defray the salary or the payments that that employee will continue to get while out on disability, so that you're not just paying it for no work being done. Health insurance. Health insurance is kind of a political football, so I don't want to go too far into this because there are different rules in different states. There's different rules because of the Affordable Care Act. Just understand this: if you are going to offer this as a benefit, you must work with somebody who understands the complexities of the laws that pertain to the state in which you are in. Again, as Andy put it, where you formed the entity is not as important as where you do business, physically where you operate out of. And if you operate totally virtual, it is still, you are still basically assigning a place where you are doing business. And that place of business could determine how you handle health insurance. I am not the expert on health insurance. In fact, to be honest, I go to our VP of benefits each and every year and I tell her, what do I need? I tell her, these are the doctors I'm seeing. These are the medicines that I'm on. Luckily, I'm not on anything specific. And these are potential prior conditions or conditions that I might have to worry about down the road. And she tells me what I need to do. It is that kind of complexity, it is that kind of nuance that goes into health insurance that you can't just blithely go into this and say, okay, I'm just going to get this policy, because it may not work for all your employees. In fact, it may backfire and really just cost you money, as opposed to actually being a real benefit to your employees. So what I tell startups is that if you are in a competitive market space and you feel health benefits are going to give you an advantage of bringing solid employees in, by all means, offer it. But find somebody who knows what you must do, what you can and can't do as it pertains to your state, and what you can do with the types of health insurance that you want to offer your employees. And then last but not least, cyber insurance. And as I mentioned, this has become a big area, because I hate to tell everybody listening into this, this is usually the part where everybody's stomach drops and what have you. Each and every one watching my video or hearing the sound of my voice will eventually experience some sort of cyber incident that is going to cost you money and is going to disrupt your business. It is just the nature of plugging a device into the internet. The moment you do, the world knows where it is, and eventually somebody will come looking to see if they can gain access to it and potentially the data that it has on it. It's just, unfortunately, the way we do business in the 21st century. And it is the way cybercrime has become basically an organized entity to gain as much money as they possibly can, just like any criminal organization will. The difference with cyber is that insurance carriers have now become very good at segmenting off cyber incidents from other incidents. In fact, where it used to blur with crime policies, that is becoming less and less of the case now, because insurance carriers are rewriting crime policies to exclude a lot of cyber incidents. So the reason why I bring cyber up, if you have any data of any kind of sensitive nature, whether that be somebody's social security number, their medical information, their home address, their kids' names, their mother's maiden name, email address with a password because you use that for them to get onto your site. If you collect data from their usage of your website or your app, or you follow them, you track them through cookies via internet browsing and whatnot, you should have cyber insurance as part of your portfolio. The reason being is states are seeing this as their obligation to protect their citizenry from misuse of that data or potential unwanted exposure of that data through cybercrime. And what they're doing is they're holding the companies who have that data responsible. And there are pretty significant penalties. In fact, the state of New York just issued a $3 million fine for somebody for mishandling their client's data. And that is not going to become an out of the ordinary number or potential fine. It's going to become a de facto source of revenue for states. And essentially, all 50 states have a breach notification law. That means a breach is a very specific legal term, and that means data that has sensitive information was violated by an outside entity. If that happens, that company in all the states in which they have customers are required to notify those customers about the breach. In some of the states, depending on the information that was compromised, they may be responsible for purchasing up to 3 years of credit monitoring for those individuals. All of that costs money. If you do not have cyber insurance, what's going to happen is that you violated those rules. You must now pay for all of this out of pocket. What really gets bad is when the regulators come in or civil plaintiff attorneys come in and they say, hey, guess what? You had 10,000 records on 10,000 customers that all got violated. We are suing you for not properly protecting and for potentially exposing my client to future financial harm through fraud or some other misuse of that information. If you do not have cyber insurance, none of the other insurance policies that I mentioned earlier are going to cover that, because those other policies are designed to protect the business and the business that you do, where cyber, as I said before, is designed to protect your IT or your cyber infrastructure and the digital data that you hold on your clients or customers. Now, I can't stress enough, everybody who has a machine plugged into the internet will eventually have some sort of cyber incident. How severe and how damaging it is depends on how prepared you are to respond to that incident. And again, that's why I tell most of my clients who are of a corporate structure is that the real damage is done is not because the technology side of your company, whether it be in-house or outsourced, doesn't know how to respond to the incident. It's because the business side doesn't know how to properly respond to the incident. And what happens by that sort of chaotic response, plaintiffs' attorneys and state regulators, and in some instances, federal regulators, depending on the type of business you do, sees the chaotic response and knows you weren't doing things the proper way. And when they know you're not doing things the proper way, they smell, it's like sharks smelling blood in the water. They're all going to come and they're going to do serious damage to you. So having the cyber insurance basically prevents the stone from rolling all the way down the hill, and could also provide you with a potential team of experts to help you navigate the repercussions of a cyber event. So Kendra, that's my full slide, I think.
Great.
Yes, no, yep, here we go.
Great. So we
you
have
got questions?
Yes, we had a bunch of questions around insurance for home businesses, home-based businesses, as well as people who are working from home, normally have an office, but due to COVID are working from home.
Okay, so it depends. Again, I'm going to lay that out there. It's just typically, as long as you're not having clients or customers come to your home, typically your renter's insurance or your homeowner's insurance can cover the items that you would typically cover with a general liability coverage on there. Your laptop gets damaged, it gets stolen, among all your other items that potentially get stolen and whatnot. Your existing renters or homeowners insurance would typically fall into that. Where things get a little bit different and where you may actually have to have general liability coverage on your home office is, as Andy stated, is if you actually have a room that is specifically your office and everything in there is business related and it's the only room that you use in the house that's for your business, you may actually have benefit from having general liability coverage on that particular portion of your home. And you can actually have commercial insurance on portions of your home. The other thing I would say is that let's say you sell a product and you're just starting up and the products are actually sitting in your home. Your inventory is actually in your home. Well, as the value of that inventory grows, you may actually want insurance to cover that inventory, which your homeowners or renters insurance will not do. Because once you file a claim and the insurance company asks, well, why do you have 50,000 pairs of socks that you're claiming on your insurance? They're going to know you were running a business under there, and they're going to say no. So in an instance like that, you would want to have commercial insurance to protect that.
Thanks. What about insurance? Is insurance required for independent contractors?
Oh, that depends on the contract between the hiring entity and the independent contractor. If I'm representing the hiring entity, the business that is hiring the independent contractor, I most certainly tell my clients, you should have a clause in there that requires your independent contractor to have insurance for the work that they're going to do for you. And then I take it one step further and I say, as part of that, I want them to name you as an additional insured on your insurance. I won't get into the details of it, but it protects that hiring entity. If I'm the independent contractor, I actually want to have insurance because, again, it protects me should something I do go wrong. Whether it be advice that I give or a website that I'm building. Let's say I'm building a website and I use old code, or I use a late edition of a website builder, and I haven't upgraded to the latest and greatest, and there's a security flaw in there that leads to a breach of my client's website that I built for them. Well, then the liability is on me, and you'd want to have that kind of coverage in place to protect yourself.
Thank you so much. How would somebody find an insurance broker?
Google, but for the most part, I would ask fellow business owners, having a relationship with your broker or agent, and I'll explain the difference between the two in just a second. It's a pretty personal relationship, especially on the health insurance side. Not so much on the commercial side, because commercial is kind of cut and dried. But you do want to have confidence that the broker understands your business, knows the types of coverages that you're going to need, especially if you have what we call weird or an unusual business, or don't fit into a box that a carrier can fully comprehend. The difference between a broker and an agent, I'm a broker, which means I work for my clients. That means I go to market and I market to all the insurance carriers that I am authorized to do policies through. Where an agent typically works with one, maybe two carriers, and they are essentially a de facto employee or de facto representative of those carriers. So their market is just confined to one or two carriers. That is just the way they chose to do it. A lot of times you would see an agent for those insurance carriers that you typically see advertised on TV. Most of the carriers that you've never heard about or what have you tend to work with brokers as opposed to agents.
Thanks, Sean. So with that, we are close to time, so we're going to go ahead and wrap things up. You guys have a lot of questions out there. I know you do. And a great resource is the SCORE Mentor. They can guide you with specific business questions. That's really what we excel at, is targeted to your business needs, your challenges. We're a great resource to help you thrive. To get a SCORE Mentor, you just go to score.org, click that Find a Mentor button, and then that's how you will get a mentor. It will ask you for your zip code, you'll enter that, and then it will hook you up with a mentor close to you. So as follow-up, we're sending you the slides as well as the webinar recording. Those will go out to you tomorrow to whatever email you used when you registered for this webinar. Please stay on and complete a webinar survey for us. Once I end this Zoom session, if you stay open, your Zoom window open, you will see the webinar survey. It lets us know what was effective about today's webinar, what we could do to improve future webinars. It's very, very valuable to us. So please just take a moment to fill that out. And with that, I'll just say thank you so much, everyone, for your engagement today. I'm sorry we weren't able to get to all your questions. I'd like to say thank you to Evan, Andy, and Sean for being with us today. And with that, enjoy the rest of your day, everyone. Bye.